All right, welcome to Wise Talk, episode 10. Excited to be back. Had about a week or so off, I think, since we actually streamed live, and Ben and George held it down the week before. So, welcome everybody. How's everybody doing this afternoon?
Wonderful.
All right.
Very
so,
well.
Everybody doing well.
Hello.
So, go ahead, Steph.
Good afternoon.
All right. So, let's dive right into it then. So, let's tip off with our first topic.
I'm telling you guys now, you got to get into cryptos. It has been January for several reasons have just been amazing in cryptos. We have Litecoin leading the way at like 41% rise in 1 month. And it was expected, but it wasn't expected that high of a rise. And what's amazing about it is we're not seeing the usual, jump up, then a little crash, then kind of lay kind of dormant for a week or two, then either up or down. We're seeing a rise, then a couple days of like flattening out, and then a rise again. And it's really, with all of the news over in China, plus we got news in Venezuela and Argentina, and Argentina, and there's some news over in Russia. It's like everything's leading. Every time Trump asked for 0% interest or negative interest rates here in America, it's like the cryptocurrencies get stronger.
What Ben's talking about is correct, though it has been slow and steady. There have been rises and then chop a few days, and then a rise and some chop. And it's taken out a couple of shallow trend lines, but it still has the price right now, live, 93.87. Lower highs, but we kept hitting that low on a lateral basis. So when we did that, they kept bouncing, bounced up and hit that spot where it kept hitting and it just wouldn't do it. That's 12K. So the point about 12K, it's really important because there are multiple points of resistance and indicators on the chart that have already proven that it's resistance. So once it gets through that, there'll probably be a run up to 20. All right. I'm not saying that there will, because there's nothing 100% accurate. Technical analysis is about 70% accurate when all is said.
I also did a video. I won't go into it too extensively, but it was last week, and I went back and studied the deflation that the United States had in the 1800s, and most people just can't even conceptualize the benefit of healthy deflation. To give you an example, prices at the end of the 1800s, so in 1900, in fact, you even take it to 1913 before the Fed, prices in 1913 were lower than they were in 1800. And in 1900, 100 years later, prices were 50% lower than they were in the year 1800. So people see that and they're like, oh yeah, okay, it kind of just goes over their head. But I actually did some math on that. If you're someone working at McDonald's right now and you're making $10 an hour, and I used all the numbers that we had in the 1800s, more specifically when we were on the classical gold standard from 1870 to roughly 1913, and I looked at what nominal GDP was. And then I kind of took all that into consideration. And what would have happened if you were making $10 an hour, let's say $1,500 a month take home, and let's just say that your bills were right at that same level at $1,500. At the end of 20 years, even if you still worked at McDonald's, you're based on nominal GDP, your wages didn't even go up at the 4% nominal GDP. They only went up at 1%. You'd be making $1,830 a month in take-home pay. Okay, same job. You're still flipping burgers. Okay, but your expenses would have gone from $1,500 all the way down to a little over $800. You see, it's just that compounding effect that you get. And from one end, you go from losing your entire life savings to having to gamble in the stock market just to break even and keep your head above water. And the other thing, you could work at McDonald's, and after 20 years, you could be rich just through proper deflation.
Stable prices. Well, stable to me means, doesn't change.
Yeah.
Okay. But the Fed targets 2% inflation, which means they're targeting loss of purchasing power. And the way I've explained this to people is in 1914, when the Fed went operational, because the Federal Reserve Bank of New York went operational in November 1914. In 1914, one 1914 dollar had the purchasing power of 100 1914 pennies. Makes sense, 100 pennies to the dollar. Some economists have estimated, and this is within reason, today's dollar has the purchasing power of 3 1914 pennies. Okay, things don't cost more today because they're so much more valuable. It's because our dollar buys so much less. So it changes the concept of what a living wage is. If that is something that has to be strived for by the country, because if you have to have a living wage and the cost of goods constantly is increasing, the cost of services are constantly increasing, what does that say about the living wage? It's got to constantly go up, and then it trickles through, all the prices go up, and then the people who were paying the living wage have less money, and part of me thinks that this whole system is set up for, in part, one reason. If we had no inflation, or if we had the beauty of deflation, and you had some extra savings, and unlike today, which you're now being told savings has no time value, especially if we go to negative interest rates. But if you had savings and you got a decent interest rate for saving it, and you had no inflation or deflation, how willing are you to go invest in Wall Street?